Guys, in 2021, investors have been piling into the shares of Alphabet. That's the parent of Google. And year to date, they've pushed up the stock by over 60%. Alphabet is now the second most owned stock by super investors, as shown by Datorama. That means that the value investing community is all over this name. So is that an indication that this stock is going to continue to go up throughout the rest of this year? In this video, we're going to dive into just that. Is Alphabet even worth investing in at its current share price? You're watching More Money. Let's get it. What's up, everyone? Thanks so much for tuning in. I'm Tay, and you're watching the #1 channel on YouTube for people that want to retire early. So let's jump right into it. As I said in the intro, in 2021, investors have been piling into Alphabet stock. That's the parent of Google. It's now the second most owned stock by super investors, just behind Facebook. But because of the activity that I've been seeing online and such, I think Alibaba will end up replacing Facebook at #1 on that list. Now, the way that I'll do the analysis in this video is basically by following the Warren Buffett 4-step approach to equity research. In this video, I'll give you a quick summary of the overall business, dive into the segments a little bit to give you a bit more important detail, conduct an assessment of management, and then finish with a valuation. And of course, if you want to deep dive into the understanding behind those 4 questions that I ask, the link to that video is in the description below. In the second video of this 2-part series, I will walk you through the free to download valuation model, which you can grab and manipulate for yourself from the description below. And guys, don't forget, the best investment that you can make is by smashing that like button. It really helps YouTube know that this channel provides valuable content, and thus you'll share it with more viewers. So diving right into it, when it comes to understanding Google's business model, it's probably safe to say that we all likely know what they do. Google primarily makes their money selling ads on the Google web search platform, YouTube, and affiliate sites. You can see from here that Google search advertising itself makes up the majority of the revenues. And then if you add in YouTube advertising and the Google network member properties, which I'll dive into more detail later, it makes up approximately 80% of Google's revenues. So the question you're probably asking, if you're not familiar with the search business, is why would advertisers want to advertise on Google? It's actually a very effective form of advertising because you end up only advertising to people that are actively searching for something that relates to your product or service. And at the end of the day, as an advertiser, isn't that exactly where we want to allocate our ad dollars anyways? For example, if I type in new TV into Google, I notice right away that Best Buy and Samsung are paying to be right at the top of the search results before the actual first result. And the cost of each click by potential customers is just pennies. So if you convert even 1% of the people that click on that paid link, the margin that you would generate on that product would be more than worthwhile for all the people that clicked that didn't turn into buyers. Advertising on Google also gives the advertiser a ton of detail about how many people are seeing the advertising impressions, how many are clicking, and how many are converting into sales. It's a really good way of developing data on your online customers. So not only is it in most cases more cost effective, but this form of advertising also provides you with much more details about your ad spending and exactly what is converting browser behavior into sales activity. Now, here's the silent secret about Google's business model and what makes it so special for the investor. It does not cost Google any material amount of capital expenditures to grow revenue. So if search increases 50% year over year, the only thing that Google will have to do is put up an additional server farm, which would be pennies compared to the revenues that it would bring in. Compare that to another excellent business, Coca-Cola. They essentially buy sugar for pennies and sell it for dollars. That's a great business. But what does Coca-Cola have to do to increase its revenues by 50%? They and their affiliated bottling organizations would have to build new plants, secure reliable sources of raw materials, buy or secure additional transport, hire thousands and thousands of new people, etc., etc. I understand that Coca-Cola outsources a lot of this, which makes their business model more of a brand, but to inevitably deliver the product, they're going to have to invest in capital assets and people. And all of those items require competing with internal and external forces such as availability of capital for expansion, security of long-term demand for product, demand and supply of local labor forces, adequate availability of industrial space, and inflationary forces and more. So that's the beauty and strength of Google's business model. It's no wonder that Google is now one of the world's largest companies. So with that, let's segue into the second question of Buffett's 4 questions that he asked when he purchases a company. Does this company have favorable long-term economics? Now, when it comes to assessing whether or not Google will have favorable long-term economics, it's almost a laughable question. I think their consumer monopoly over search is stronger than any other consumer monopoly that I've ever seen. And guys, don't even bring up Bing in the comments or DuckDuckGo or whatever other search engines there are out there. Google owns this market. And to be honest, I think Google search has been around for as long as the internet has been relevant. I remember in 1998 when Google first showed up, I immediately started using it. And back then, most people used Yahoo search, but Google was just the better option. It was a cleaner interface and it just felt like it was a better search engine. And then it inevitably became the best search engine. So in terms of long-term economics, I think Google has a lock. Now let's quickly dig into a bit of their segments, because here's where many people may learn something, as Google likely does a lot more than you think. Now, Google reports their segments as Google Services, Google Clouds, and other bets. Google Services is their bread and butter. This is where 92% of their revenues come from, and over 100% of their operating profit, as their other segments, albeit are growing, are currently not generating any profits. Google Services consists of Google Search, YouTube, and the Google Network member properties. Now, just quickly on Google Search, we already went over this one, but note that they deliver Google searches through google.com, the Google Search app, Google Play, Gmail, and Google Maps. I think they pay Apple like $1 billion a year to be the default search engine on the Apple phones as well. Now, moving on to YouTube quickly. YouTube is big, and besides Google Cloud, it is Google's fastest growing segment. YouTube's revenues have increased at an annualized rate of over 30% since 2017, and it looks like 2021 is trending in that direction as well. And those 2021 results are really being helped by a really cute finance nerd that has started his channel in 2021. Now, there's no sign of slowdown with YouTube. It's now the world's second largest search engine, and for good reason. Personally, I love using YouTube to learn new things, from topics ranging from investments to cooking to watching new movie trailers, daily news, and lately even gardening. Google actually generates 10 sources of income from their YouTube platform. And as you may have imagined, these sources of income are largely a symbiotic relationship with the creators on YouTube. As creators make more income, they will create more, and thus they'll generate more eyeballs to the platform, thus making it a more valuable space for advertisers. Now, of the 10 revenue streams, I'll just discuss one and leave a link in the description for you to look at the others. YouTube advertising revenues is the main way that YouTube generates revenues from the platform. YouTube takes approximately 45% of the revenues from the ads that are run on the creator's channel. For YouTubers like myself who are not partnered right now, YouTube keeps 100% of the revenues. That's why I personally like to promote my Patreon. It's the only way that I can earn income from the platform at the moment. You've likely seen these ads on the YouTube platform because they include skippable and non-skippable ads. They also include sponsored searches. YouTube is creating something similar with YouTube Shorts, which we may see in the future. That's their competitor to TikTok. Now, moving on to Google Network member properties, this consists of revenues generated from AdMob, AdSense, and Google Ad Manager. Without going too deep into it, AdMob is Google advertising in apps. AdSense is Google advertising on creator websites, and Google Ad Manager gives creators the ability to control what types of ads get shown on their websites or content in an effort to focus more on the user experience. Now, that's it for Google Services. Let's get into the segment that has everyone incredibly excited, Google Cloud. There has been a cloud adoption for technology for over a decade and a half already, and I think the industry is still in its infancy. If you think about it, we all store our information and data on the cloud without even realizing it. For example, all of my emails are in the cloud. How we speak with people through cloud-based mediums like Zoom, WhatsApp, Facebook Messenger, or Instagram. Cloud computing in general helps companies and other organizations have access to strong computing power, greater and safer storage, all in a more secure server for less cost. So essentially, cloud-based offerings are a business that helps other businesses do more with less, which is a winning formula. And of course, this explains the massive growth that the cloud business has been experiencing. From here, you can see that this growth is accelerating, as 470 billion of growth is expected over the next 5 years versus 205 billion of growth in the past 5 years. And COVID really woke companies up to the fact that they have to digitize in order to be competitive in this new environment. And we're not just talking about IT companies. Google Cloud Services, major players in retail, healthcare, financial services, media and entertainment, industrial and manufacturing, and the public sector. Now, capturing significant market share in this space isn't easy. As powerful as Google is, they are competing against two major powerhouses in Microsoft with their Azure product and Amazon with their AWS service. And it's not looking good right now, as the Google Cloud offering has not been adopted at the same rate at which the Amazon and Microsoft offerings have. But the good thing is that there are an incredible number of current and growing use cases for cloud adoption, which is leading to rapid adoption and growth in the industry. Google is aware that they can't just distribute the benefits of the cloud-based systems on their own, just like they don't distribute search on their own. So they are cultivating a strong momentum with their ecosystem, which consists of the who's who of companies that provide Google with a faster way to scale distribution with lower costs. This is a brilliant strategy, and it has been working, as they have been able to kick it into overdrive since 2018. They have virtually all major companies working with them, which is resonating into that top line with 46% year-over-year growth in 2020. And from my model, we can see that in 2021, the revenue is expected to grow at approximately 33% based on the 6-month year-to-date results. And I'm not slowing down the growth going forward over the next 5 years. I really think this segment grows at approximately 30% a year into 2025. What a lot of people don't know is that when Google renamed themselves Alphabet, it's actually a pun, Alpha Bet, as described by their co-founder, Larry Page. It implies that Google has subsidiaries that are working on projects ranging from self-driving cars to cancer cures that won't just make the world better, but these are businesses with better than average return profiles. So the bets part really means that they're making bets that can really generate a lot of wealth for the shareholders. One exciting company that I wanted to highlight here was Waymo, Google's self-driving taxi and autonomous trucking company. I believe that if Alphabet makes trucking autonomous and sells the product on some sort of recurring SaaS model so that there's no heavy capital investment for existing trucking operators, they can really own this space and revolutionize the world. But they are up against a clock because everybody is going after this market. But if they do it successfully, Alphabet will have single-handedly brought down the cost of goods significantly, and Alphabet will be worth significantly more than it's currently worth today. Now, the major revenues in the other bets segment are derived primarily from 3 areas. The first is Google Play, which includes revenues from the sale of apps and in-app purchases. You will be familiar with Google Play if you have had an Android device. The second area of revenues in this segment comes from the sale of their hardware. This includes Google Nest, Google Home products, Pixelbooks, Pixel phones, the Google Chromecast, which I absolutely love, and I have on every TV in my home. And finally, in this segment, they generate revenues from YouTube non-advertising services. This includes YouTube Premium and YouTube TV subscriptions and other services. Now let's jump into the analysis of the management team. The first area that I like to look at is with an analysis over their capital management. What exactly is management doing with their generated cash flow? From the cash flow statement, we can see that they generated $56 billion in free cash flow. Of that amount, $31 billion was paid out to shareholders in share buybacks. The remainder was parked on the balance sheet. What we can infer from here is that Alphabet is no longer interested in watching the cash hoard on their balance sheet grow, as it has reached over $100 billion. They're looking to pay it out to shareholders in the form of share buybacks. I expect major share buybacks to continue into the future, so I don't see any issues on the capital management front, and this leads us to the financial statement analysis. Google has very limited debt, and the cash on hand is almost 10 times the amount of debt that the company has, so there's no issues there. It's largely a clean balance sheet. So overall, management has done a great job in returning capital to shareholders and have kept the financial statements clean. I also agree with management's strategy of aggressively growing out the cloud business, focusing on YouTube's growth, and developing for the future with the likes of Waymo and their other big bet type businesses. Now, before moving on into the valuation, guys, just a reminder that I'll be doing a complete deep dive into the free to download model in the second part of this Google series. So in order to not miss out on that video, please consider subscribing to the channel and hitting that notification bell to be notified when I upload that video. Also, if you haven't done so, please consider making the best investment that you've ever made in your life, which is investing in the smashing of that like button. It really helps YouTube know that this channel provides valuable content, and thus they'll share it with more viewers like yourself. Now, moving on to the valuation. Of course, I'll be going into much more detail in the next video, but for now, I wanted to mention that I'm currently valuing Google at approximately $3,100 a share. This reflects about a 14% upside to the current share price. The way that I'm modeling this out is by using a 5-year forecast model. I'm using 5 years because this allows YouTube and Google Cloud to grow out. Also, it gives Google Cloud the ability to reach profitability. I'm using a 25 times multiple at the end of 5 years because I believe that Google will have the ability to command a premium multiple at that time, as there will still be huge upside potential with search, cloud, and YouTube. And let's not forget the potential of Waymo and their cancer-fighting big bets. Now guys, just an FYI, my valuation does not take into account any upside from their autonomous driving Waymo project or any of their cancer curing products that are currently under development. So like I said, there could be significant upside to my valuation. This is how I value companies. I like there to be upside. I'm not going to give them credit for it if I don't have any credibility that it will be achieved. Finally, the valuation does take into account the approximate $100 billion cash hoard that they have on the balance sheet. For a deep dive into the valuation, guys, stay tuned for video number 2 of this 2-part series. That's it for now. I'll see you later.